The S&P 500 rallied for its fifth consecutive day as we've all but made up for the losses in the market over the month of September here, just most of it being made up in the last week or two within the S&P 500 at least. So strong positive price action once again. We did have some positive news on the earnings front, at least in the case of Johnson & Johnson. However, on the other hand, we did have some consumer staples like Procter Gamble struggling a little bit more. We also saw interest rates rise, which put a little bit of pressure on the real estate investment trusts. But all in all, this was a very positive day for those that want to be bullish within this market. So we'll take a look at all that information. We'll then decide how it has changed our posture, if at all, and then we'll take a look at our trade application example where I wanted to focus on one of those beaten up consumer staples companies for a sold put opportunity to try to purchase it at a lower price than where it's trading today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 19th, 2021. First of all, for those of you that are new, feel free to go on over to our YouTube channel and click subscribe. While you're there, check out our description down below where you can sign up for our email distribution list. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. I really appreciate those of you that click like and retweet on those Market Outlook related tweets as well. And sometimes I'll give you a heads up as to some of the trades that I'm thinking about for these videos. Earlier in the day, I was chatting with one person on Twitter regarding the idea of selling puts on consumer staples here while the stock market was open earlier today. So make sure you're following me there if you're interested in that commentary. Also, we have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And you can see I've got the heat map of the S&P 500 pulled up here in front of us just to give us a sense of some of the bigger movers within the market here today. I mentioned in the intro that one of the stories was Johnson & Johnson reporting earnings. You can see that square is nicely green here, and they did end up going up by over 2%, which of course is a big move for a $500 billion company or whatever it is that Johnson & Johnson is these days. It's close to it at least. Procter Gamble, on the other hand, disappointed Wall Street. Now it didn't end up being as bad as it was earlier on, but Procter Gamble was still the worst performer within the Dow Jones Industrial Average. It was down just over 1% here today. You can see some of our bigger players out there like Apple and Microsoft both finished in the green, helping drag the market higher. In terms of any rough patches out there, we do see one really dark shaded red box there, a rectangle, and that is from Ulta Beauty. They were down 10% today, and I think that was the worst performer within the S&P 500, as that chain that focuses on selling beauty products has kind of given Wall Street a heads up as to what it expects out of its own growth prospects in the years to come. And then also, you'll notice overall to the right-hand side here, in addition to Procter & Gamble, we also saw noted weakness within a number of the other household products types of companies, whether it's Colgate or Kimberly-Clark or Clorox, even some of the tobacco and food companies like Philip Morris, Altria, and Estee Lauder. Then we also have some pink showing up here kind of in the real estate section. And again, that may be as a result of interest rates heading higher here once again today. Remember, when interest rates head higher, interest rate sensitive areas like the REITs do tend to underperform. So I think that's probably the reason behind that particular move. Let's go ahead and take a look at the main indices now. This is chart 4B for those of you that are premium market scholars who are following along on your own charting package that we provide to all of you. A reminder that there are 50 plus personalized charts that we give all of our premium members. Anyway, as we take a look here at chart 4B, you can see this is a 4-grid for the 4 major U.S. equity indices that helps us through color coding understand what the current posture is of these securities based upon the market forecast technical indicator that you can find on the Thinkorswim platform. So let's review today's session. And today was a day where the S&P 500 actually was the strongest performer. Now, it wasn't a huge day. We weren't up more than 1%, but still, it was a 0.74% day, so up nearly 0.75%. And not only that, but context is important here, knowing that, as I mentioned in the intro, this is the 5th consecutive day of increases. In fact, we're not all that far away from hitting an all-time high. Just like that, it feels like kind of a snap of the fingers. Again, for those of you that follow me on Twitter, you'll know that I was tweeting late last week that this was looking like it was heading for a inverted head and shoulders reversal breakout to the upside, right? With this being the left shoulder, this being the head, this being the right shoulder, and us breaking up and through that neckline here late last week has provided a little bit of upward surge for this continued move into this current week that we find ourselves in. Naturally, stocks don't go up every single day, so there will without a doubt be some sort of a give back here along the way. When that happens is anybody's guess, but I wouldn't blame you if you figured it might happen here in the next day or two. Without a doubt, there are going to be some technicians out there that are going to look at this prior level where we stalled out back here in late August into early September, where we basically just flatlined there for an entire week. We eventually hit a new all-time high at 45.45 on the S&P 500. And you can see we're not all that far away from that right now, only about 25 points away. And to put that into perspective, we were up 33 points today. So in other words, another day like today, and we would be hitting new all-time highs. It's remarkable how quickly sentiment has changed after a lot of people were feeling pain during this difficult period within that month of September. But as we mentioned at that time, remember from a seasonality perspective, September tends to be a more difficult month for the stock market. October can be as well, but October is equally as known for forming a bottom as it is for potential market crashes. So in other words, we should be on the alert for those opportunities when they do emerge. And it feels like that is kind of the process we've been going through here more recently as we then head into the end of the year. In fact, I was tweeting about this earlier today as well, the so-called Santa Claus rally, where traditionally the months of November, December, and January are actually some of the better months. And in fact, it's the best 3-month period within the S&P 500 from a seasonality perspective. Now, obviously, seasonality does not hold every single year, but at least can provide a bit of a roadmap if we have nothing else to bank on. And right now, this is playing out almost exactly the way it played out last year, where we also had a pullback in the month of September and then ended up rallying into the end of the year. So I have no reason to believe that can't be achieved once again this time around. Anyway, with today's big move, continuing the prior 4 days, you'll notice that we now have a dark green background color on the chart of the S&P 500, which tells us we now have a strongly bullish posture according to the intermediate line on the market forecast technical indicator. Remember when I was last with you on Thursday, since David is still on his vacation overseas right now, I was last with you here on this candle, and I was mentioning how we do have a weekly bullish posture, but because we've now rallied 2 more further days, we now have what's known as a strongly bullish posture as that green line has crossed up and through the chart's 50th percentile. So in other words, we've gained more bullishness as time has gone on. Naturally, that should be the case. If the stock market has gone up 5 days in a row, you should be at least leaning a little bit more bullishly today than you were prior to that move, at least if you're reading the charts. So good signs there all around from the S&P 500. Can now see that the Dow Jones Industrial Average also had a good day. It was up 0.56% today, so while that wasn't as strong as the S&P 500, one thing I would point out in defense of the Dow Jones Industrial Average is its intermediate reading at 78 is actually the strongest of all 4 of these charts we have in front of us. So this might be a moment where those blue chips are actually our leading index at this moment in time. Remember, the blue chips don't get as much press out there as perhaps like the Teslas and the Netflixes of the world. Netflix reported their earnings after hours tonight. The last I checked, it was flat. But the point is, those are not part of the Dow Jones Industrial Average, although they are very exciting stocks. And so a lot of times what you find are that when the stock market gets a little bit more chaotic, sometimes folks feel more comfortable in the blue chip companies like your Johnson & Johnsons of the world. So maybe they benefited from that aspect this time around as markets got choppy into September and now are rebounding. Maybe it was just a situation where the Dow Jones did not go down as much as some of the other indices and therefore has a little bit of an edge when it's time to recover, like we're in right now in this recovery zone. This is the fourth straight day. Actually, I take that back. We might have been down. Yeah, we were down yesterday on the Dow. So that is not the same shape as we had over here on the S&P 500. However, you will see that the Dow Jones does have a green moving average, whereas the S&P 500 does not. What distinguishes those two is that the S&P 500 is still trading above a falling moving average. This is a 30-day moving average here. And the Dow Jones Industrial Average is trading above a rising 30-day moving average. So in other words, because the Dow Jones was able to start rebounding faster, all of the most recent 30 days that goes into the calculation of that 30-day moving average has had a chance to bend more bullishly with more recent price activity. Notice, for example, over here on September 21st, and then again over here on October 1st, you had basically equal lows at that time, whereas over here on the S&P 500, here's the 21st, and here's the 1st. In other words, we went down. This was not an equal low. This was lower lows on the S&P 500. At the same time, the Dow was giving us equal lows. So in other words, there was more pent-up bullishness within the Dow Jones Industrial Average. That's easier to see, of course, in hindsight, but we can now recognize why is the moving average tilted higher first on the Dow Jones as opposed to not quite tilting higher first on the S&P 500. You can see down below here, the Russell 2000 shares that same attribute where its price is above a rising moving average, and it's the same story there. Remember, the Russell 2000 was a bit different than all the rest of these in that it didn't really go down spectacularly in the month of September. Did it go down below its moving average? Yes, it did, but not dramatically so the way that the others did. So this has been more of a sideways performer during a time that there's been a bit more volatility in the other indices. But because it didn't go down so much, you can see that its moving average doesn't even have the color of red consistently throughout the last couple of months, the way that we obviously see it with the Dow, the S&P 500, and the Nasdaq. And so because we didn't have that negative price action negatively impacting the 30-day moving average, it's had an ability to rise much more quickly than the S&P 500 and the Nasdaq Composite. But again, I want to stress that the intermediate line on the Russell 2000 is only at 71. Now that's good, don't get me wrong, but the point I'm trying to make is it is worse than what we're seeing on the Dow Jones. And remember, when I was with you last week, that wasn't necessarily the case. So what that's telling us is that this rebound in the Dow has been much more vicious to the upside than what we've seen here with the Russell 2000. It's been a bit more of a whimper to the upside. We'll take upside, don't get me wrong, but it's been more aggressive to the upside with the Dow Jones Industrial Average, and that's kind of allowed it to kind of become our leader in this market a little bit more clearly, whereas they were kind of neck and neck for leadership a week ago. The Nasdaq Composite was up today as well. It was up 0.71%, so just shy of the S&P 500's move, whereas the Russell 2000 was up the least amount today, only up 0.36%. But both of them have the strongly bullish background color. So that makes all four of these charts now strongly bullish from an intermediate perspective using that market forecast technical indicator. The Nasdaq Composite, similar to the S&P 500, does still have a yellow moving average telling us that price is now above a falling moving average. So when you're looking at these different indices here, all of them are strongly bullish, but I would say that the Dow Jones and the Russell 2000 are more strongly bullish than what we see from the postures over on the S&P 500 and the Nasdaq at this exact moment in time. But obviously, this is a really nice rally we've all participated in here over the last couple of weeks, especially considering the concern and the fear that had entered into the markets here in the month of September. Speaking of fear, let's just pull up the the VIX real quick, because I want to show you how quickly we've unwound volatility in this market. Just here on September 20th, the VIX had nearly touched 30. It went up to 28.79. Take a look at where we are trading right now. We are below 16. So we have actually crossed below a point, or at least at the point of where the prior high of the market is. Remember, the VIX itself ties directly into the S&P 500, so that would be the comparative tool here. But the S&P 500 topped out on September 2nd. Where the VIX was on September 2nd was right here. And notice that it closed that day. You can read up here in the C colon. I'll read it out for those of you whose screens are too small for that. But it says 16.41. Today it's at 15.7. In other words, the volatility levels are actually less right here, right now, than they were when the market was hitting an all-time high back here. We haven't yet hit an all-time high, yet we've already surpassed it on the downside when it comes to the VIX. So for those of you that have been selling premium here in the last few weeks and months, you've really received a gift there in that regard. Some of you might have saw my tweet over the weekend that we passed quite the milestone in my put selling classes and also here in the Market Outlook video by having 100 straight wins when it comes to selling puts. It's actually 103 to be precise, but that is noteworthy because in all of my years of teaching options classes, we've never gotten into the triple digits in terms of consecutive wins. So it's been a heck of a run that we've been on. Many of you have participated in that run right alongside me, and you guys have done a great job, particularly in the options for long-term investors class, where many of those trades are voted upon collectively by an audience. So really great to see that success, but even better to be doing it in the face of everybody else's fear here in the month of September. When volatility was higher, premiums were juicier. We want to sell juicy premiums, and we get a bigger benefit when they expire worthless in that particular case. So great job to all of you who kind of were bucking the trend there during the month of September, looking for stocks you actually wanted to own at lower levels and being willing to sell puts upon those, as a lot of other people were busy pulling their hair out during that time period. All right, let's take a look here now at our 3 green arrows chart setup. And this will be chart 4B for those of you that are premium members. I'm sorry, my apologies. That's not 4B. It is actually chart 4D. There we go. D as in dog. And this is our 3 green arrows chart setup. And 3 green arrows is basically just colorful language to look at 3 different technical indicators and try to determine if they are giving us bullish signs or bearish signs at any given moment in time. And if all 3 of the technical indicators are giving us bullish signs at the same time, then we would identify that as a 3 green arrows setup. And as you can see from the background colors of all 4 of these charts, that's exactly where we stand right now. All 4 of our charts currently have 3 green arrows setups. Whether you're looking at the S&P 500 with its green arrow there on the 30-day moving average as price went above that 30-day moving average, or the MACD histogram green arrow that came in, a week or 2 ago due to improved pricing momentum within the market, or whether you're looking at the green arrow there on the stochastic, letting us know that we've been closing near the highs of recent trading ranges here more recently. And so all of those things combined together generally identify a healthier market. And of course, this is actually our 4th straight day of 3 green arrows. So this is not some sort of a new transition. This actually started occurring right back here on the 14th, so last week, and we've now gone up 3 or 4 days in a row since having that 3 green arrow setup on the S&P 500. And again, you can see the setups over here on the other 3 indices as well, with that green background telling us, yep, across the board, bullishness. So this has been a robust rally regardless of what corner of the market you've been hanging out in. Let's go ahead and take a pop on over here towards the internet. I always like to get a chance to say thank you to those of you that help support this project called the Market Outlook Video. Remember, we do this completely on a volunteer basis. We don't get paid to do this. We don't force you guys to watch advertising from random companies that would want to advertise with us. Instead, we do it to help educate you guys and hopefully help promote our own premium business where we do make money by selling subscriptions. So we kind of need you guys to kind of help support the video in order for us to have justification for taking 3 hours out of our day to do the videos. A lot of times you guys only see the 30 minutes or so that we do the video on the recording, but of course we're doing all the prep work, the research, the analysis, the posting of the notifications, the editing of the videos, the writing up of the paragraph, which you guys see up here. Takes quite a bit of time to write out all that stuff, and then making sure people are updated on social media and all that. So the point is there's a lot that goes into this beyond what you guys see in the analysis portion itself, and we've never made a cent from any of it despite doing it as often as we do. So if you want us to continue to do these free videos, we ask one and only one thing out of you: help support the project. Best way to do that, click like for us there on Twitter. I figure as long as we're getting at least 100 likes on Twitter, I'm satisfied with that and will be willing to continue to do it. We got up to 110 the last time around, so thank you to all 110 of you that committed to clicking like there for us on Thursday when I did the video, and I would encourage you to do that yet again here today if you want me to do the video again this next Thursday. Also, while we're over here, a reminder that I did teach my dividend growth investing class today, where we did focus on the consumer staples area. That was an area that was out of favor in the market, and as most of you dividend investors are aware, when stock prices fall, dividend yields go up, and all else being equal, become more attractive to us long-term dividend growth investors. So we did focus on the consumer staples in our head-to-head matchup here today earlier in class. So if you're a plus or a premium member, feel free to go check out that recording up here on our Trading Rooms calendar. It should be listed there and waiting for you to watch. Tomorrow, I will be teaching my factor-based swing trading class at 11 a.m. Eastern Time. I'll look forward to spending an hour or so with you there in the morning. Also, over here on the sector selector, remember this gets updated on Friday afternoons, but since I traditionally do this video on Tuesdays, this is the first chance I get to kind of review it with you guys here, although we've already reviewed it in my top-down trend trading class yesterday for premium members. Nonetheless, just a heads up as to any rotations that might have been taking place from a sector perspective here more recently. You can see once again, we've got energy and financials leading the way in this market. It's really those two and everybody else. Yeah, there's some, good movements here and there, but consistently, you find consistent strength within energy and within financials. Within all of these other sectors, you're kind of having a few industries here and there that might be up, but then other industries within that sector down. So it's a little bit more hit and miss there. Now, naturally, as the stock market starts to get its feet underneath of it and we start chugging higher, it appears here towards year end, you'll start seeing more stable movements within all of these. But in the choppier fall months that we've been trading through here more recently, it really has been energy and financials leading the way, and everybody else is just kind of vying for third place at any given moment in time. I will mention that we did see materials make a bit of a surprise entrance into the top four, which is what we tend to focus on in my top-down trend trading class. We hadn't seen materials in the top four for over 3 months. You can kind of track this gold ball backwards here, and you'll see that the highest position it had prior to this most recent move was probably back here in August 13th time period when it was about at the 6th rank. So we went up to the 5th last week and then 4th this week. So this is the first time we've been in the top four going back at least 3 months of this rolling graphic. And so I think that the materials are starting to benefit from some of the same things that energy has benefited from here more recently. In fact, I was having this conversation here today on Twitter with a couple of other FinTwit members whom I respect. But I was mentioning that, it wouldn't bother me if energy and materials were eventually combined into the same sector, because they oftentimes do benefit from some of the same macro considerations, including an anti-dollar play, inflationary pressures, and it's their own cyclicality. Whereas the same person I was talking with there on Twitter was saying that they wouldn't mind seeing real estate and financials kind of go back together, but there I don't think there's as much support, at least from me, to do that due to the way that they think about interest rate sensitivity there. But regardless, everybody's got a different opinion on this type of thing, right? And there's definitely a case to be made in different corners, without a doubt. Did want to point out here that the consumer staples were dead last on the sector selector. And a reminder that the sector selector in this case is built on an equal weighted basis, not a market cap weighted basis, and it's built purely on price activity. It has nothing to do with a security's valuation or its prospects for the future. It's basically just saying, where is money rotating into right now? So back to what I had mentioned before, within our dividend growth investing class today, like I was mentioning to that class, if you're going to use the sector selector, which we don't use specifically for that class, we use it for my top-down trend trading class on Monday, which is a momentum trading class. But if you are an investor for the long term and you wanted to use the sector selector, then I would encourage you to look at the ones that are at the bottom, not at the top. Those are the ones who, in all likelihood, have seen their stock prices fall, and therefore their dividend yields have become more attractive. So different ways of approaching this. If you're a trader, concentrate on the top. If you're a long-term investor looking to put money to work at specific times when there are sell-offs around, then you might want to concentrate on the lower portion of the sector selector. Let's go ahead and get back into some more analysis on the Thinkorswim platform now. Let's do some 12 grid analysis, starting with chart 5A. Now, one of the big macro events of the day is Bitcoin had a futures ETF released, which is going to make it a bit easier for the average person who has a stock brokerage account to participate in Bitcoin. And the ticker symbol for that is BITO. And there's going to be other Bitcoin futures ETFs released likely in coming days as well. But that one from ProShares will be the first one. BITO is the ticker symbol there. It's not even coming up here for me quite yet on these charts, so maybe that's a paper money function. I did pull it up earlier on my real money account, so I know it's working over there. But anyway, just thought I would let you know about that, since that was kind of a big thing that folks on business television and others were talking about here today. So if you wanted exposure to Bitcoin, now you have something beyond the GBTC, which was a Bitcoin trust. Now you actually have a Bitcoin ETF based upon its futures. Now remember, futures ETFs have kind of gotten a bad rep over time because of the rolling of the futures contracts within that process and the slippage that occurs where you're not actually able to track perfectly either a commodity or, in this case, a cryptocurrency. So you do have to be a little bit more careful around that. However, it might open things up to more options trading capabilities, right? That's one thing about GBTC as a trust. It doesn't have options trading on it. Eventually, BITO likely will have options trading on it the same way that SPY has options trading on it. So while this might not seem like a big deal to some of you, for others who have been wanting to trade options on Bitcoin and you don't want to open up a futures account specifically to do that, then there will be some more ease of use coming your way. So we'll be on the lookout to see how that performs going forward. But you can see that in anticipation of that announcement of the ETF, which was kind of leaked late last week, Bitcoin itself was really rallying. Notice the chart of Bitcoin. We closed at 63,000 here today, so just shy of an all-time high, which was just above, I believe, 64,000 several months ago. But this has been a really stellar move that it has made here in the last couple of weeks, as word has been leaking out that a Bitcoin ETF would be on the horizon. So a very strong 4% plus move today on Bitcoin, which follows very strong moves for really the last couple of weeks there. So one of the best performing asset classes out there at this exact moment in time, with obviously a strongly bullish posture according to the market forecast. Other things to be aware of, I mentioned this slightly already, but interest rate environment also increased once again today. Notice that the 10-year Treasury was up today and it closed at 1.63. Notice how quickly that unwound as well. We're back to new multi-month highs on interest rates. Remember last week we actually had this 3-day sell-off here. If anything, that was just an opportunity to load up on your financials as they were reporting their earnings, and many of them continued to move higher. In fact, we bought a very well-known and well-regarded financial company that many of you probably use from a service perspective just yesterday in my top-down trend trading class there. But remember, financials, all else being equal, tend to benefit when interest rates rise due to the expanding net interest margins that many of them are privy to. When yields rise, we tend to find sell-offs in the bond market and other fixed income-oriented areas. Notice TLT is rolling over now. Remember what I mentioned to you guys in this very video last week, which is we had this oversold cluster signal, in fact, back-to-back oversold cluster signals. We then got a rally towards the upside, and I said if we start falling up here, this is probably an opportunity to get bearish on TLT, whether you short it outright or sell a bear call spread or what have you. And notice how quickly the view of that chart has changed in our minds. It looked like it was rallying furiously last week, and now it looks like, yep, rolling over yet again, falling back into that downtrend where the path of least resistance continues to be interest rates higher, bond prices lower. So be interesting to see how that shakes out going forward. But maybe some of you were able to sell some bear call spreads there on TLT. It's a very liquid bond fund that has that opportunity available to those who wanted to take it there last week. You can see that the dollar fell today as well. Notice the dollar has actually been pretty weak for the last couple of weeks, which is a little bit surprising because it had just looked like it wanted to break out here maybe about a week and a half ago or thereabouts, and for the last week and a half has really started falling. But here's the deal. It is sitting right on a rising 30-day moving average. If it's going to bounce, naturally this would be a good place where that bounce could exist. Now, you don't have that speculative appetite that you had with TLT last week when you actually had oversold cluster signals, right? We don't have that here. But we do have another form of support. It's not oversold support. Nonetheless, we do have the support of the 30-day moving average, which oftentimes does act as a support launch area. So for those of you that are brave souls, perhaps doing something bullish on the US dollar right now could be a useful exercise, at least in the near term. In terms of the upper rung here, notice that we do have positive price action in all three of our major markets around the world. Today we were led higher by the emerging markets. We were up 1.33% there. So while none of those charts really look all that great from a trending perspective, at least the postures are back to that dark green background color, supporting more bullish activity moving forward. One of the areas that, of course, has been the leader of the market alongside of Bitcoin recently has been oil. Be aware that oil was once again up today. In fact, at one point today, we hit multi-year highs on oil. Now remember, this is USO, which is an ETN that tracks oil, but you can always look at crude oil futures by typing in /CL on your Thinkorswim platform, and you can see that we closed right around 82.5 on crude oil futures here today, which again, multi-year highs there out of the blue for oil, and of course that's been supportive for energy stocks like your Chevrons of the world. Speaking of which, let's go ahead and take a look at the various sectors out there. Chart 5C is next on the docket, and you can see it was a positive day for oil stocks like Chevron today. XLE did close higher by more than 1%, 1.13% to be exact, which was basically third place today because we did have an outperformance day out of XLV finally. Remember, we talked about that oversold cluster last week in this video as well. Some of you that were brave might have been trying to play that counter trend move right there, and you've been rewarded for it thus far. You're kind of at a juncture here where there could be the possibility of a sell-off underneath that falling 30-day moving average, so be on the lookout for that. But today was a good day for healthcare, up 1.31%. You also had a good day out of utilities, somewhat surprisingly there, up 1.26%. And then energy was up the third most. But of those three that I just mentioned that were up over 1% today, without a doubt, it is energy that is our leader of those three. The other two are still trading either at or below their moving averages, whereas energy surpassed its moving average way back here on the 22nd of September. And as soon as it went through that 30-day moving average, it just kept on on motoring higher right alongside oil futures prices. So again, as mentioned before, this has been a market led by oil and gas companies, whether people want that or not, right? A lot of people don't want to have anything to do with oil and gas companies, but you can't deny the furious price action that we've seen out of those types of stocks here more recently. You can also see that along with energy and financials looking really strong on the charts, I would throw discretionary in there for consideration as well. However, I always like to point out that discretionary in this case with XLY is market cap weighted. It's not as though the average discretionary stock is doing this well, but this XLY product has the advantage of having Tesla, Amazon, and Home Depot as basically its three most important components. In fact, they pretty much drive the entire trading behavior of that product because most of the other discretionary stocks are so small that they just can't have the ability to make a major impact on their own, whereas Amazon and Tesla absolutely can. So this move that we've seen here is partly as a result of strength in those particular areas. Nonetheless, you can see a really brilliant breakout to the upside in discretionary stocks, so it might not hurt sniffing around that particular sector for some opportunities as well. Let's get into our trade application example now. And as mentioned to you previously, it was going to be on the consumer staples area. And in particular, I'm going to pull up our dividend stair-step chart here that I use for my Monday afternoon options for long-term investors class and also my Tuesday morning dividend growth investing class. And I want to pull up ticker symbol KMB. Now this is Kimberly-Clark, of course, the company well known for Kleenex, Kotex, and other toilet paper types of options, along with paper towels and napkins and all that kind of stuff. So a very well-known and well-regarded company throughout history. In fact, this is a dividend aristocrat company that many of you will hear me talk about. In other words, it's part of the S&P 500 and has raised its dividends every single year for at least a quarter of a century. In Kimberly-Clark's case, it's actually closer to a half a century rather than a quarter of a century in their specific dividend increase streak at around 50 years. So obviously a well-regarded blue chip company. And it was falling out of favor here this morning right alongside Procter & Gamble. I'd mentioned that Procter & Gamble came out with their earnings announcement, disappointed Wall Street. So a lot of the consumer packaged goods and household products types of companies out there did start struggling right alongside of Procter & Gamble. And there was actually a lot of them that I was looking at. Unilever was on my radar, as was Clorox, in terms of an ability to sell a put on. I opted to go with Kimberly-Clark here in the end because first of all, I admire and respect the company a lot. And you can also see that it's been a long time since we've been able to buy this stock at the blue line here. The last time we were able to do it was back here at basically the lows of the coronavirus pullback in March of 2020. You can see that the price of that bar came down and crossed through the blue stair-step line there. And so we have not been able to make that claim ever since then on this blue chip company. For those of you that are unfamiliar with this chart, this dividend stair-step chart is made through computer programming language known as ThinkScript and is unique to every single individual stock because every stock has a different yield history. For Kimberly-Clark specifically, if you can buy that company when it has a yield of 3.79 or higher, like this blue label says up here at the top, then traditionally throughout history, that's been an attractive time to establish a long-term position. And you can see that's absolutely been the case with Kimberly-Clark here over the last decade. Had you been fortunate enough to buy it when it was in the blue zone over here, you'd have a smile on your face today. Had you been fortunate enough to buy it when it was in the blue zone over here, you'd have a smile on your face today, just like right there as well. And then that brings us to this most recent time in March of 2020. Well, obviously we're not there at this exact moment in time, but it's selling off enough here in the last few weeks where it's setting up that possibility of us to do what's known as a put sale, which is actually a bullish strategy, despite the term put in there. A lot of times newbies to the options world might think that anything that says put in it is bearish. But in this case, when you're selling a put, it's like two double negatives become a positive, right? When you're selling a put, it's actually a bullish strategy. And it's one that we implement regularly. As mentioned before, we have over 100 straight wins with this particular trade strategy that I've implemented both here and in my Options for Long-Term Investors class. So it can be one where you find some success because you start off with the odds in your favor when you intentionally try to sell out of the money puts, which is the way that I teach it. And so you can see here that in order for this stock to be attractive, based upon the average high yield philosophy, we'd want to buy it at $120.32, even though it's trading at $129 right now. So what I opted to do is to sell the 120 put in the month of December. Now remember, the trade was already done earlier today. And I usually target the 1% return on risk area. And so I wanted to point something out as a benefit to those of you who are premium members of Market Scholars, because while I didn't know it at the time, my timing of when I placed this trade was nearly perfect. Obviously, that hardly ever happens, which is the whole point of me pointing it out to you specifically this time around, because it was a very unique aspect, and it does kind of serve to help you recognize why you might want to become a premium member of Market Scholars to receive access to our Telegram notifications right when we place the trades. Because as you can see here, I did sell the 120 December put. Notice that I sold it, where's my trade price area? There it is, for $1.45. Notice that it's trading for $1.15. I just did this trade earlier today, and so we've already made $30 per share. Now, we only did one contract just for educational purposes here, but you're going to have to sell as many contracts as you desire, or whatever best fits for your own position sizing and what have you. But the point that I want to show you here is how the timing was nearly perfect here. I didn't know it at the time. I was just satisfied with getting filled at that time. But if you click on the trade price, I think it is here, you will see, I know this is hard for those of you that are watching on a phone to be able to see, so I'll read it out to you, but this was just afternoon my time. I'm in the Mountain Time zone here, so 12:05 my time, and 21 seconds, so 12:05 with 21 seconds. Now notice up here where this stock bottomed. It bottomed at 128.15. And notice at what time it bottomed. So I'm going to zoom in on that 1 day, 1 minute chart up there. And you'll notice that the stock literally bottomed in the exact minute that I sold those put contracts. And again, I didn't know at the time. I was just satisfied with that level. In fact, I had the limit order sitting there for me for about 20 minutes prior to that. But it got filled right there. And the benefit that you guys as premium members receive is that I immediately went and sent out the Telegram notification to all of you who are premium members. And so you can see here that was timestamped at 12:07. So remember, I did the trade at 12:05 and 21 seconds, and by 12:07 I had already taken the screenshot and sent out the notification to those of you that might have also wanted to place that trade as well. So for all of you that got filled there at 145, you basically got filled at the exact low of that stock, which is what we want when we want to be bullish, right? We want to do things when stock prices are low and hope that they go up after that, which is of course exactly what happened here for Kimberly-Clark. And it's rare for a boring old consumer staples company like this to make such a big percentage return for you. We made 20% in just a couple of hours of time on this trade, which is, again, a very boring company traditionally. But, that timing element worked really nicely there, and I can assure you that won't happen all the time. In fact, it will rarely happen. But in the few times that it does happen, you can see the benefit of having access to that information before everybody else. Notice there was a lot of big volume coming in right there as well. So perhaps a lot of people who received my trade notification also sold puts around that time. Remember, if the market maker is on the other side of you, basically buying the puts that you're selling, they then need to hedge themselves by buying the stock, and their buying of the stock might have actually set off the rally of Kimberly-Clark from the low of 128.15 exactly when I sold my puts to where they closed at 129.77. So again, normally I don't spend as much time talking about a timing element of a sold put trade, which is a trade that traditionally you want to be in for several weeks. It's not a day trade, but I wanted to at least share that aspect of it with those of you that are kind of on the fence right now as to whether you want to join Market Scholars or not. And one of the huge benefits that you receive from David and I is that we will let you know right when we're doing our trades, so that way you can consider them for your own portfolios as well. So what that means for me is I have to be willing to buy Kimberly-Clark at $120 there on the December expiration there in the middle of December, which I would be willing to do, judging by its history of always finding support right around that area when it yields about 3.79% with its dividend yield. All right, that will wrap it up for the day. I appreciate you checking out this video. I hope you got some good analysis out of it and learned a few things along the way. If you did get benefit out of it, I ask one thing out of you. Please click like for me there on Twitter. As long as we've got at least 100 folks doing that for me regularly, I'm happy to do the videos. So thanks again for checking this out. Remember, David's still on vacation, so there won't be a video tomorrow, but I will plan on being with you here on Thursday. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.